Let's see how we do. First question, which of the following is not a benefit of being a corporation? The correct answer is E, that earnings are taxed as personal income. They're not. We have the double taxation being the main drawback of the corporation. All of the others are benefits of being a corporation. So that question went well. Question 2, the goal of the corporation is commonly stated to maximize the firm's stock price. Remember, we're trying to create value for the owners. That's not minimizing the owner's equity. It's not maximizing the firm's market share. We talked about that can be a conflict with creating value because it doesn't take into account the cost of creating market share. Not minimizing risk or maximizing the number of shares of stock, it's maximizing shareholder wealth, and that's most commonly viewed by the value of the ownership share that you have. So maximizing the stock price. That's an important concept right here. So that's why I'm emphasizing this question so much. That's one that you'll want to make a note of if you didn't get that one correct. Question 3, which of the following is not true about agency costs? The correct answer was A. They do not exist the same in sole proprietorships as corporations. If I'm a sole proprietor, I'm in business, and my goal is to make money for me, and I make decisions that benefit me, and the ownership and the running of the business is all aligned. Same thing with a partnership. The partners are in business to benefit themselves. They make decisions that benefit themselves. We don't have a conflict of interest. But in a corporation, the owners are separate from the managers that run the corporation. And so there, the managers are supposed to make decisions that benefit the shareholders. But they might not. It's that separation that creates these potential conflicts of interest. And so that's why A is the incorrect answer. B, indirect agency costs include missed opportunities but not actual dollars that's spent. That is true. That is the definition of indirect agency costs. They can be reduced through compensation contracts. We talked about using compensation or the control of the firm, the threat of being fired as another way. They result as of a conflict of interest between the principal and the agent. That's also true. Any questions about any of those? All right, I have some used financial calculators. I have the HP 10Bs. That's all I'll have for used calculators, but I have about 20 of them down here. If you want to buy one, come on down. $20 cash. Again, we'll start using these in about 2 weeks, I think, just before the first exam. There's a limited number of used calculators this go around, so I'll, as long as I have them available, I'll make them work. I'll have them on Thursday as well, as long as I have some leftovers. Yeah. Anybody else? That's all today? All right. I will have them on Thursday. Given the demand in some of the other classes and the number of calculators, that might be it, for a last chance. If you want to stop by my office this afternoon or tomorrow, you can certainly do that as well, and I'll have those available. All right. First, I have to tie my shoe. Let's see, one more announcement, and it's kind of faded, but that's what they sent me. So the Harbert Connects, which is a formal mentorship program that we have in the College of Business, is open for applications now. You can apply on Handshake by August 31st, which is, just a couple days away, a few days away. For more information, you can visit the Office of Professional and Career Development on the first floor. And you can ask me, and I can point you to the right person if you forget. This is a great opportunity. If you're thinking about a particular career path, they partner you up with oftentimes alums or other people that have connected with the College of Business that do that. And so it's a formal mentorship program over a period of time where you interact with that person. And I'm not sure exactly the degree to which, whether it's phone calls or shadowing, and I think it's open to some various different types of mentorship. So if you're thinking about a particular career, it's a great way to start networking So I highly encourage you to consider that. And the Office of Professional Career and Development can hook you up with that. All right, any questions for me before we dive in? Today we're going to talk about financial statements. And just to kind of illustrate the types of things that we'll be able to uncover when we know more about the financial statements, I have Coke and Pepsi information here for last fiscal year, 2017. And if you look at the bottom number here, total assets, you can see that Coca-Cola is bigger than PepsiCo by, I don't know, about what, $8 billion. So these are in millions, so that would be about $8 billion. So Coke is bigger than Pepsi, but if you look at sales this past year, Pepsi had significantly more sales than Coke. How can a company that's smaller generate so much more in sales? And then if we look at sales, let's just pick Coca-Cola. They had $35 billion in sales. That resulted in about $1.2 billion of net income. And Pepsi had about $30 billion more in sales, but only about $3.5 billion more in net income. And so how do we get that difference? We talk about net income sometimes. We focus on net income or profit, but what is the big difference there between sales and profit? And then if we look at these numbers here, Pepsi generated almost $5 billion in net income, but their cash only increased by $1.5 billion. So where did that money go? If they generated $5 billion in net income, but they only increased their cash balance by $1.5 billion. And here, Coca-Cola generated $1.2 billion in net income and actually ended the year with $2.5 billion less in cash. And so how can that be? Or where can we go to find out why that is? And that's what we're going to talk about as we talk about the financial statements of the firm. And so this is corresponding with Chapter 2 and the first section of Chapter 3. So Chapter 2 and Section 3.1 of Chapter 3. Now, when we talk about the financial statements of the firm, I want to talk about the difference between the annual report and the Form 10-K. Now, the annual report is really a public relations piece. It's sent to all shareholders. It talks about the annual meeting, usually, that's coming up, and all shareholders are invited to the annual meeting. They get to vote on the board of directors. We talked about shareholders electing the board of directors. But the annual report it's a glossy, picture-type document. It does have financial information in it, but it also has pictures of, happy employees and happy customers and all the wonderful things we make and that sort of thing. The Form 10-K is the official filing with the Securities and Exchange Commission. It's the official financial statements and the notes to the financial statements that the firm files with the SEC. It does not have any glossy pictures. It's a text document. In fact, it's a template, and it looks very similar across companies, with the exception of the company name that's typed in under the company name stuff. So I'll show you what that looks like. But oftentimes, the annual report that you'll get, it'll say annual report and Form 10-K. So they'll have the annual report, and then tucked in there, they'll also have the financial statements and notes to financial statements as part of the Form 10-K. When we think about the financial statements, we usually think about the balance sheet, the income statement, the statement of cash flows, and then often a statement of stockholders' equity or something along those lines. Now, for our purposes, we're going to focus on these first three. That's what we're going to dial in on. And we'll talk in some detail about these statements, how they're constructed, what information they tell us. We'll look at examples of just like a textbook type example that's in your notes. Then we'll also look at the Home Depot financial statements to see where it's similar and where it's different. Now, the financial statements, this Form 10-K that's filed with the SEC, that's made available to everybody, not just current shareholders, but any potential shareholders as well. You can look that up online. And if you do that, you would go to the SEC's database for financial filings called EDGAR. Now, EDGAR stands for You don't need to write this down, by the way, just so that you know it's not named after some guy named Edgar. It's the electronic data gathering, analysis, and retrieval is what it's the acronym. So when we talk about the Edgar database, that's what it's referring to. And to get there, we're going to go to sec.gov. I'm going to actually pull this up here, or attempt to. That's not what I want to do. All right, hang on. We're going to get there. Maybe. There we go. All right, so this is the SEC's webpage, sec.gov. There is no Southeastern Conference football on it. And so there's a couple of different ways that you can search, and they seem to change how they search. So down here, there's a quick link to Edgar Company filings. We can also come up here to filings and look it up that way, and go to Edgar search tools. I'm just going to come down here, and I'm going to type Home Depot. So now what I have are all of the filings for Home Depot, not just their financial statements, any filings of insider trading, the voting mechanism, the proxy statement that we talked about that happens at the annual meeting where shareholders get to vote for stuff, any quarterly filings, quarterly earnings announcements, any important information that the company needs to report. All of that is filed and it's in this database. And so that's what we see here. And if we scroll down a little bit, or a lot of it, let's see, we might have to go to the next page. Here's the 10K here, back in March 22nd of this year. So I'm going to click on Documents and click on that. So this is the Form 10K. Again, no glossy pictures. You'll see the annual report will have a glossy picture. I'll show you that in a second. Other than this little logo right here, it says the Home Depot Inc. here. If I pull up Starbucks, it'll look very similar. It'll just have Starbucks or Disney or whatever company. All of these little fields are filled in for Home Depot's specific information. Then I can go down to the table of contents. Item number 8, you can see there's a number of different things here. It's about 65 pages long. Item number 8 says financial statements and supplementary data, and we can click on that, and that'll jump us to page 29, and there we have the balance sheet and the income statement. We're going to look at this in more detail shortly, but that's what the Form 10K looks like. That's how you can find it. That might be useful as you're doing research in another class, maybe as you're looking up company information. You want to go and look for the financial statements. You can certainly go to the company's web pages under Investor Relations. They will often link to their filings. Sometimes they just link you straight to the Edgar database. So that's what we're going to be talking about. All right, before we get into the financial statements themselves, I want to have you keep in mind a couple of things as we talk about the financial statements. First is the perspective. By definition, the financial statements are backward looking. The financial statements are backward looking. It's a historical reporting of what has already happened. So this is what the firm did last year. It doesn't say anything about what the firm is going to do next year. Maybe the firm had a great last year. It doesn't mean it's going to do great next year. Maybe the firm did terrible last year. Doesn't mean it's going to do terrible next year. So keep that in mind, that perspective, that by definition, these financial statements are backward looking. And in finance, what we care about is being forward looking. And so we want to keep that perspective in mind. Another thing to keep in mind is the difference between accounting numbers and actual cash flows. Accounting numbers versus actual cash flows. And that will make more sense as we start working through the financial statements and highlighting those differences. But the accounting statements are going to have accounting measures of value. They're going to have accounting measures of profit. And that's different than actual cash flows. Dollars and cents that the firm receives. Dollars and cents that the firm pays. And so our accounting system is based on accruals, where you accrue revenues and expenses, you report them in the same period, We'll talk about some of those differences, but that doesn't mean the cash is coming and going at the same time. And in finance, what we really care about are the cash flows. And so we'll see those differences as we talk through these financial statements as well. All right, the first statement is the balance sheet. The balance sheet is a snapshot of the firm at a single point in time. It's on a single day. A snapshot of the firm at a single point in time. So it will say, on this day, this is the balance sheet of the firm. It's not for the year, it's not over a window of time, it's at a single point in time. This is the balance sheet of the firm. And as we think about the balance sheet, we can think about the balance sheet identity. And we've already talked about this a little bit, or refreshed it a little bit, when we talked about the balance sheet model of the firm, and we talked about those 3 questions that define corporate finance. Then we set up a balance sheet, and we overlaid those questions onto the balance sheet to see how that fits. And so what is the balance sheet identity or the balance sheet equation? It's always true about all balance sheets.
Assets on the left.
Assets equal
Liabilities and stockholders' equity.
liabilities plus stockholders' equity, right? That's not the goal of the balance sheet. That's an identity. It's like saying 1 + 1 = 2. It's always true. And so the assets, those are the things that we own. Assets are the things that we own. Liabilities and equity, that's how we pay for them. So liabilities, that's money that we borrowed and promised to repay. Equity is owner's money that they've given us to buy stuff. And what we own always equals how we paid for it. Always, always. And that's why it balances. Assets, what we own, equals how we paid for it. Liabilities and stockholders' equity. Now, when we think about the balance sheet, we want to think about liquidity and how it relates to the balance sheet. And before we do that, let's define liquidity. So what does it mean to be liquid or to have liquidity? What is liquidity if an asset has liquidity?
Sell it quick.
We can sell it quick. We can convert it into cash quickly. I think we can probably all agree with that part, right? So a liquid asset is one that we can convert into cash quickly. So, for example, if you have, I usually use the textbook of the course as an example if I'm doing it at the very beginning of the class, but I'm not sure that the window is still there where you can return your textbook for full value. So let's pretend for a second, I don't know if the bookstore still takes the textbooks back if you in the wrong class, but let's assume that they can. Then is your textbook a liquid asset? Could you convert it into cash quickly? Yeah, you go to the bookstore, they give you a full refund. Certainly last week I think they would do that so that if you got the wrong book or you were in the wrong class, they would take it back. So that would be an example of a liquid asset. What about my house? Is my house a liquid asset?
No.
No? You haven't seen my house.
Can you sell it within a month? I mean, or within a certain amount of time?
Yeah, so we have this certain amount of time that I can sell it. I mean, can I convert it quickly into cash? No?
Depends on how much you sell it for.
Yeah, I would argue that I could convert it into cash by the end of the day. Could I? Sure. I guess, yeah. If what? Yeah, I sell it for a really low price, right? So when we think about liquidity, because generally real estate is not considered a liquid asset, as a general rule. It doesn't mean you couldn't sell it quickly. If the right buyer showed up at your door at the right time with a big pile of cash, yeah, you could. But generally speaking, real estate is not considered a liquid asset. It takes more time. And so we need another piece of our definition when we think about liquidity. It's how quickly we can convert something into cash without a significant loss of value. Right? So we need that other condition there. without a significant loss of value. Now let's think about liquidity in the balance sheet. Now when we think about the balance sheet, we think about assets. And at the top we have our current assets, and the first one is always what? Cash. And then what comes after cash? Somebody said it. AR, accounts receivable. And the third one is inventories. Cash, accounts receivable, inventories. Why? Why is cash always first? Why are they always in that order?
What's the most liquid asset?
They're in order of decreasing liquidity. Items on the balance sheet are listed in order of decreasing liquidity. The most liquid is cash. It's at the top. Usually, not always, but usually accounts receivable is the next most liquid. And then inventories after that. Our current assets are those assets that we expect to convert into cash in the coming year. Our current assets are the assets we expect to convert into cash in the coming year. And so that's why they're at the top. They're the most liquid. But even among those, cash, accounts receivable, inventories in that order, in order of decreasing liquidity. And then underneath that, we have our fixed assets, our long-term assets. What we call property, plant, and equipment. So sometimes you'll see a PP&E, property, plant, and equipment, our long-term assets. Those assets that we do not expect to convert into cash in the coming year. So property, real estate, plant being factories, and equipment, machinery. Those are long-term assets. We're going to use them, and they extend their useful life as more than a year. And then underneath those, we have our intangible assets. Because assets, things that we own that have value, aren't necessarily just things that we can touch, like factories and machinery. But intangible assets would include things like the value of patents and trademarks. Goodwill, you might see goodwill listed. So when we acquire another company, goodwill is only generated when we acquire other companies. When we acquire other companies, we pay more than the value that we can kind of allocate among their assets. So we're paying for maybe the reputation value of the company is how I think of it. And so it gets recorded as goodwill. So that's an intangible asset, and the intangible assets are at the bottom because they are the least liquid. We cannot quickly and easily convert them into cash without a significant loss of value. It'll take time to shop them around. So when we think about the balance sheet, we want to think about that they're listed in order of decreasing liquidity. And we're going to talk a little bit more about this last bullet point, the pros and cons of liquid assets, when we talk about financial statement analysis, probably next Tuesday. But just now, as we're thinking about liquidity in the balance sheet, let's think about the pros and cons of liquid assets. So when we think about these liquid assets, this liquidity, what is the benefit of having liquidity? As a firm, what is the benefit of having liquid assets or having liquidity? You know, we generally think liquidity is good, but why is it good?
You're not going to lose it.
You're not going to lose it? Okay.
Like, you just got a bunch of cash. It's not going to go anywhere.
Okay, so it's not risky in that sense, right? It has lower risk. I would agree with that. What else?
Pay off debts.
Yeah, you can pay off debts. You can pay off your bills when they come due, right? That's the benefit of having some money in your checking account, right? That when the bill comes, then you can write the check and pay for it. That's liquidity in your personal situation. And the same is true for the firm, that if we have liquid assets, we're able to convert that into cash, or we expect to convert it into cash in the coming period, and then we can use that to pay off bills as they come due. Now let's talk about the flip side. What is the drawback then to having a lot of liquidity?
Get tied up in lawsuits.
You get tied up in lawsuits?
I'm just saying, like, if you had a bunch of cash and something happened, you can be responsible right off the bat, have to pay.
No, not necessarily. So whether I have the cash or not, so if I'm in some lawsuit and I owe the money, they'll make me sell off some assets if I have to. So it's not really whether I have cash to pay it or not. they'll get my money somehow if I'm found, liable for something. So I'm not sure that exactly gets to.
Well, then cash doesn't make you any money. You don't get any interest on cash.
There you go. Liquid assets don't earn any rate of return. You don't earn any rate of return on those liquid assets. That's exactly right. So I can have all the cash under my mattress at home, and I'm able to pay my bills when they come due, but I'm not earning any rate of return. And we said the goal of the firm is to do what?
Maximize profit.
No, we didn't say that.
Share, price of the shares. or
Maximize the price of the shares to create value for the owners of the company, right? That's different than, just don't lose the money, right? I'll give you money, but just don't lose my money. That's not what we're giving them money to do, to just not lose it. We're giving them money to take some risks and to make money for us, to create value for us. And so we have this trade-off with liquidity. We want to have enough liquidity to pay our bills when they come due, but we don't want to have too much liquidity because that's money that we're not investing in longer-term assets that earn a higher rate of return. So we have this trade-off. It's not that more is always better. We want to have enough, but not too much. And so we'll talk more about that when we talk about the financial ratios and financial statement analysis. But it's worth keeping in mind now as we talk about liquidity. So let's look at this balance sheet. This is for Yost Rocks. It's a landscape company. And you have this in your notes, I think, right? So I want to talk about just this as a textbook example. I always kind of balance something nice and easy about using a textbook example of the financial statements, but then I feel like we lose something not looking at the real financial statements, so I just do both. You'll notice up at the top, on this day, this is the balance sheet of the firm. It doesn't say for the year ended, for the period, it's on December 31st, 2017. This is what we own, and this is how we paid for it. At that point in time. I have assets over here on the left, liabilities and equity on the right. Oftentimes you'll see assets at the top and then liabilities and equity underneath. But over here we have, again, assets in order of decreasing liquidity. At the top we have our current assets, cash, and then accounts receivable, and then inventories, total current assets. Then we have our fixed assets. We have property, plant, and equipment. We're going to subtract out accumulated depreciation to get net property, plant, and equipment. That's a book value. We'll talk about book values in a moment. That's the book value, the accounting value of that property, plant, and equipment. And then we have our intangible assets at the bottom, because again, they are the least liquid. And then we have total assets of $1879. Current assets, those we expect to convert into cash in the coming year. Long-term assets, those we don't expect to convert into cash in the coming year. Intangibles are the least liquid, they're at the bottom. Everything is in order of decreasing liquidity. On the right-hand side, we have our liabilities and stockholders' equity. And so we have our current liabilities at the top. Those are the monies that we owe that we're going to pay back in the coming year. So current assets in the coming year, current liabilities in the coming year. We have accounts payable. That's money that we owe our suppliers that we haven't had to pay yet. Accounts receivable is money that our customers owe us that we haven't received yet, but over here, so that's a benefit, but over here is the cost money that we owe other people that we haven't had to pay yet. Notes payable is loans that we have to pay with interest in the coming year. Accrued expenses, those are expenses that we've incurred, but we haven't had to pay yet. So for example, our employees, we pay them every 2 weeks. They've worked for a week. They've accrued this expense that we owe them, but we haven't had to pay them yet. We don't have to pay them until next week. We've used electricity over the month, but we haven't had to pay our electric bill yet. That's an accrued expense. So that gives us our total current liabilities. Then we have our long-term liabilities, long-term debt here, money that we owe that we don't have to pay in the coming year, but that we owe beyond the coming year. Then down here on the right-hand side, we have our stockholders' equity. This is the owner's money. This is the owner's portion. So we have preferred stock and common stock. We'll talk more about that later on in the semester. We have accumulated retained earnings, which I'll talk more about in a second, and that gives us total equity. If we add current and long-term liabilities, liabilities plus stockholders' equity gives me $1879. Total assets equal total liabilities plus stockholders' equity. Another thing that we can get from the balance sheet is the capital structure of the firm. The capital structure, we said, remember when we talked about those 3 questions that define corporate finance? What should we buy, the long-term assets? How do we pay for it? Long-term debt and equity. And so that's what the capital structure of the firm is looking at. And so we can look at the ratio of debt to equity. The proportion of those assets that are paid for with the owner's money, 805 out of 1879 was paid for with owner's money. The remaining almost $1,000 out of the 1879 was paid for with borrowed money. And so that tells us something about the capital structure of the firm, that mix of debt and equity. We're going to talk about this accumulated retained earnings number. So we have $390 million in accumulated retained earnings for this company. What does that tell me? What is retained earnings? Anybody know?
Money that hasn't been paid out to the shareholders.
It's money that hasn't been paid out to shareholders.
So for income that hasn't been.
Right, so income that hasn't been paid out to shareholders. So we'll get to the income statement in a minute, but there's 2 things we can do with net income. That's money that belongs to the owners. We can pay it out in dividends, or we can reinvest it back into the firm for them, right? We talked about this a little bit back in chapter 1 when we had that diagram. We were making, I forget what we were making, but widgets, I think. And then we were, we bought assets, we produced cash flow, we paid taxes, and then we said we can pay out dividends or reinvest it back into the firm. All of that is the owner's money. Whether we give it back to them in the form of dividends or whether we reinvest it back into the firm on their behalf, it's their money. If we reinvest it back into the firm on their behalf, it goes under equity here. It's more equity that the owners are giving us. But that's an addition to retained earnings. And so this retained earnings on the balance sheet is accumulated retained earnings. That tells us over the life of the company, how many dollars in earnings did the firm reinvest back into the firm on owner's behalf? Earnings that were not paid out, but were reinvested back into the firm on their behalf. So over the life of this company, we've taken $390 million in earnings that we didn't give to the shareholders directly, that we reinvested back into the firm for them. It's still their money. It's under equity here. Does that mean we have some account that has $390 million in it that we can tap into? It does not. It is not a cash fund. It's not some slush fund that we have. What it represents is $390 million that we've spent somewhere over here. It may be up in cash, but it may be in inventories, it may be in fixed assets. It's already represented somewhere over here. It's money that's already been spent. It's already reflected on the assets side of the balance sheet. But that's what that represents. Not money that the owners gave us when they bought shares of stock, but money that their ownership generated and was reinvested back into the firm on their behalf. Does that make sense? To anybody. Does that make sense to anybody? Okay, good. Just making sure you're awake there. All right. Any questions about the balance sheet before we move forward? So what I want to do now is look at the Home Depot balance sheet. And you have this in your course packet. If you have the course packet, it's at the end of this set of notes. It's on the web page as well under today's lecture. And so yours is in black and white, but here's the color version, and you can see the color version. This is the annual report. So this is from Home Depot's webpage. As a shareholder, you might get the annual report. It's got the glossy pictures on it that I told you about. Now in here, as we saw, will be the Form 10-K that has the financial statements, no glossy pictures. So just to kind of separate those two. But we have the annual report here. I'm going to just flip through the first few pages that you have. By the way, what you have in your course packet is not the complete annual report. As you saw on the an Edgar, the Form 10-K was 65 some odd pages. You have like 15. So I've just kind of taken a portion of it, just the stuff that we're going to talk about. So just know what you have is not the complete thing. So if you flip the page, you'll see there's a letter to shareholders there. We're not going to go through all of that. Keep flipping. It talks a little bit about some highlights. And then you get this Form 10K, which is the boring page, right? Because this is the official filing. This is the SEC template. And it'll look the same as you go across companies with the exception of that little logo and information that's filled out in this form. I'm going to flip the page again. You have a table of contents, and you can see item number 8 is highlighted because that's really all that you have. It's highlighted, right? Not really on this. You can't really tell that it's highlighted, but it is highlighted. Item number 8, it starts on page 29. That's really all you have in your set of notes here. And you don't even have all of item number 8. So just again, to put in perspective what you have. So flip the page again. There's just some commonly used terms and definitions. And then you'll see item number 8, financial statements and supplementary data, table of contents. It'll say page 29 at the bottom in the middle. And so that's where we've jumped to now in the Form 10K. Turn the page one more time. You'll see the report from the independent auditors. So this is information, this is the opinion of the auditors. We talked about those agency costs. We pay money, direct agency costs, to hire an independent auditor to audit the annual financial statements of the corporation to reduce those agency conflicts. So that's the opinion of the independent auditor. When we turn the page again, it'll say page 31 at the bottom in the middle. And then you've got 2 page numbers because you have the course packet page number and the Form 10K page number. So I'm talking about the page number in the bottom center. It says page 31, it's the Home Depot Consolidated Balance Sheet. And that's what we're going to talk about here. Let me be clear about the following. You will not be asked anything specific about Home Depot's balance sheet. So here we're not thinking, oh, I need to study Home Depot's balance sheet and make sure I know how much they have in inventory in 2017. This is just to illustrate what we saw with the textbook balance sheet. And what I want you to see as you look at this is you'll see some stuff that's different, some stuff that's not in the textbook, simple example. But what I want you to pay attention to are the similarities. The format that's the same. So looking first at the top right-hand corner, you'll see that you have the date that the balance sheet is prepared. Now, Home Depot's fiscal year end is not December 31st. It's actually the end of January. So you can see on January 28th, 2018. Now, it's 2018, but it's considered the 2017 fiscal year for Home Depot. It goes from February through January. But since it covers almost all of 2017, it would be considered the 2017 fiscal year. So you can see that it's on this day. This is the balance sheet, single point in time. You'll see that the items are listed in order of decreasing liquidity. So we have assets at the top. We have the current assets at the top of those assets. And we have cash, then accounts receivable, then inventories, and we have other current assets and total current assets. Then we have net property and equipment. So on our textbook example, it said property, plant, equipment, less accumulated depreciation, and then that gave us net property, plant, and equipment. Here it just says net property, plant, and equipment. So it doesn't give us that specific breakdown of $22 billion. Then we have goodwill. And again, goodwill is an intangible asset. So those are considered least liquid. It's at the bottom of the assets. Total assets of $44,529,000,000 for Home Depot on this day. And then we get to the bottom half, or the right-hand side of the balance sheet, which is liabilities and stockholders' equity. Again, we'll see the same sort of thing. We'll have current liabilities first. So we have short-term debt, accounts payable, and accrued expenses. We have some other payables there, other money that we owe that we haven't paid yet. We have total current liabilities. And then we have long-term debt, excluding current installments. So the way this works is, let's say I have a mortgage on my home and it's a 30-year mortgage. The part that I owe this coming year, that's a current liability. Everything else is a long-term liability. And so that's what we have here is long-term debt, excluding the current installments. The portion due in the next year, that's up there under short-term debt. $24 billion in long-term debt. And then we have some other long-term liabilities. Total liabilities of $43 billion, and then we have stockholders' equity down here, common stock and paid-in capital. We have retained earnings of almost $40 billion. And so over the life of Home Depot, the firm has generated earnings, it's paid out dividends but it's also taken earnings and reinvested a total of $40 billion over the life of the firm back into the firm on behalf of its owners. And so that's accumulated retained earnings. We have some other adjustments there, and that gives us total stockholders' equity, which is a small number here this year because of some share repurchases. Add the liabilities and the equity, we get $44,529 million, which is exactly the same as total assets because the balance sheet always balances. All right. Any questions about that? So here's my question. We have this long-term debt, excluding current installments, $24,267 million. I think, is it 267? I think that's right. Maybe it's 287. It's a small number. Where does that come from? What is that? Now, is that one bank loan for $24 billion? Or is that a bunch of bank loans? Or are those bonds? Bonds are money that we borrow from investors. We'll talk about bonds later on in the semester. And if it's a bond issue, is it one bond issue or is it many bond issues? We know it's not due next year, but is it due 2 years from now or 20 years from now? Those are important questions. And what I want you to realize is that the balance sheet, and for that matter, all of the financial statements, are just a summary table. It's just a summary page of information. And if you really want to know what's behind these numbers, where these numbers come from, that's where the notes to the financial statements come in. And so if you look down at the bottom of all of the financial statements, you'll see accompanying notes to consolidated financial statements. And so you have your packet here. Let's flip to the notes to the financial statements. You have the balance sheets. Keep flipping past the financial statements. You have the statement of earnings. Then you have the statement of comprehensive income, statement of stockholders' equity, statement of cash flows. It'll say page 36 in the center page number at the bottom, and it will say at the top, notes to consolidated financial statements, note number 1, summary of significant accounting policies. Note number 1 is always a summary of significant accounting policies. And so it's going to document the different accounting choices that the firm has made. So again, it's no surprise to somebody analyzing the financial statements. We're going to flip past note number 1. It's several pages long. And we're going to get to somewhere. It'll say note number 4 about halfway down the page, and it'll say page 44 in the bottom center. It's going to jump from page 41 to page 44. Because again, I just have given you excerpts of the financial statements. So it says page 44 in the bottom center, and about 2/3 of the way down it says debt and derivative instruments, note number 4. So if you want to know information about short-term debt, that 1559, or long-term debt, you can see it has some information there on page 44. Turn the page to page 45. So that's what long-term debt is made up of. All of those different loans. Those are bond issues. It tells you what the rates are. It tells you when they're due. It tells you how frequently interest is paid. Some of it is due in 2018, 19, 20. Some of it's not due until 2056. And you can see what the amounts are listed there in the right column. And then at the bottom of that list, you can see it has total long-term debt minus or less current installments. Gives you long-term debt excluding current installments of $24,267. That's where that number comes from right there. So again, the point is that if you want information about what these numbers mean, where they come from, keep in mind this is just the balance sheet is just a summary table of information. And the real information is in the notes to the financial statements. And so we saw note number 4 deals with just debt, just the short-term and long-term debt. There are other notes that will deal with some of those other values. Not every single value is going to have some 3-page note on it, but those that are made up of a number of different things will. All right, any questions about any of that stuff? All right, a couple more things as we think about wrapping up the balance sheet here. I said we want to keep in mind the difference between accounting values and cash flows. And related to that is this difference between book values and market values. And so let's define what market value and book value are. The market value of an asset is the price you can buy or sell the asset for today. The market value of the asset is the price you can buy or sell the asset for today. So when they're looking at, appraising a home for what its value is, what is its market value, they look at what other similar homes have recently sold for as an indication of what you could sell your home for. And so that's an indication of market value. There was a house that was for sale for a long time over on my side of town, and one of my colleagues who does some real estate stuff had taken a picture of the sign. So had a sign, for sale, price to sell. And then, sometime later it hadn't sold, and then it said price below market value. And then that sign was there for a long time. Well, maybe not. If you can't sell it, then maybe that's not the market value of the land, right? The market value is the price you can buy or sell for. So what is book value? Book value is an accounting measure of value. And it's defined this way. It's the price you paid for the asset when you bought it, minus accumulated depreciation. It's the price you paid for the asset minus accumulated depreciation.
That's the book value?
That's the book value. Price you paid for the asset minus accumulated depreciation. Now depreciation, and we'll talk more later in the semester about how we get depreciation, but that's just a tax deduction for basically the wear and tear of the asset. If I buy the asset, there are certain rules that allow me to depreciate certain amounts over time. I might have an asset that has a book value of 0. It's been fully depreciated. Does that mean I'm not allowed to use it? No, I can use the asset. If it still works, I can still use it. But the accounting value is 0. It might have value to me. I might even be able to sell it for something. But the accounting value is 0. And so we want to keep in mind that difference between what the real value of an asset is versus its accounting value. And so it's not an exact translation, but I think about football tickets. I have tickets to, I have season tickets. And so there's a list price, right? There's a face value of those tickets. And then there's a market value for those tickets, right? A price I can actually buy and sell those tickets for. And so if you have a ticket to this Saturday's game, I don't know, what is the face value of the ticket for this Saturday's game? 50? Okay, now if you're in Atlanta at, lunchtime on Saturday, waving around your ticket, what is the market value of that ticket? I mean, you can go on StubHub, for example, and see what the market value is. What is the market value? Does anyone know what they're going for on StubHub or something?
Probably close to one.
That's right. So and that's just an example, though, of this difference between what you can actually sell the asset for or buy the asset for versus an accounting measure of value, when it's recorded at when you buy the asset. So we want to keep that in mind. Now, here's where that comes in. Where on the balance sheet can we find the true market value of the firm? The price, the true value of the firm's assets? The answer is real small on the bottom right-hand corner. No, I'm just kidding. The answer is you can't. It's not on there. The balance sheet lists book values, not market values. The balance sheet lists book values, not market values. Now, for some assets, they may be similar, right? Cash is cash. Don't have to worry about that. Or short-term assets, accounts receivable, inventories, they're generally about market value. We're going to sell them quickly, so their value usually reflects about market value. Longer-term assets, not necessarily. Intangible assets, probably not. And where it really comes in is an equity. equity that's on the balance sheet is the book value of equity, not the market value of equity. So what that reflects is when the firm sold shares of stock initially, it received some money. That gets recorded as the book value of equity. Now, it might have sold those shares of stock back in 1889. It might have sold them back in the 50s. Might have sold them yesterday. But whenever it sold it, that's when that money gets recorded on the balance sheet as the book value of equity. And then each year as we generate retained earnings, it gets added to that accumulated retained earnings. It's not adjusted for inflation. It's not adjusted for how well the firm does. The value of equity on the balance sheet reflects the book value of equity. And that can be very different than the market value of equity. What we care about is the market value of equity. What is the true value of my ownership? My piece of ownership if I'm a shareholder. And so how do we find the true market value of stockholders' equity? Well, the first part of that answer is not on the balance sheet. It is not there, not even close. The balance sheet has book value of equity, not market value of equity. And so how do we find the true market value of stockholders' equity? Well, that's the price per share times the number of shares. The price per share times the number of shares. The price per share, that's what it's trading at right now. That's the market value of my piece of ownership. Times the number of pieces of ownership that exist, the number of shares of stock that are outstanding. Now let's tie that back into the goal of the firm. We said the goal of the firm was to do what? Maximize shareholder wealth. Are we trying to maximize the market value of their ownership or the book value of their ownership? The market value. So we want to keep that in mind. That's why we care about the stock price going up. We don't care about the book value of equity going up or down. What we care about is the stock price going up or down. In fact, you can see here, just as an example, for Home Depot, over the last year, their stockholders' equity went from $4.3 billion to $1.45 billion. Oh no, they must have done terrible, right? No, they did really well last year. Created a lot of wealth for the owners. And so we want to keep that distinction in mind, that what we care about is the market value of equity. Any questions about the balance sheet? Yes?
I'm sorry, I didn't hear the part where you said the goal of the firm.
The goal of the firm is to maximize shareholder wealth, to create value for the owners. And what we're trying to create is market value. That's what we care about. So that's why we care about the stock price. That second question in today's quiz, the goal of the firm, see the stock price go up. That's market value. That's what we care about. You guys don't look like you're having fun with the balance sheet. So I'm going to try again with the income statement. We'll see if we can do better. It might not be as exciting of information, of all the stuff we'll talk about in the semester, because when we get into some problem-solving calculation stuff, that'll be perhaps more dynamic. But the financial statements, we rely on them so much to get information. It's important to understand them, to know what we're getting, and where that might be a problem, or where it's a limitation. So that's why we want to focus on that now. All right, the income statement. The balance sheet was at a single point in time. It's the only statement that's at a single point in time of the statements we're going to talk about. The income statement is over a window of time, over a period of time. So we're going to have things like sales and income, right? You don't have sales and income at a single point. You have sales and income over a window of time. And the basic income statement equation is revenues minus expenses equals income. Revenues minus expenses equals income. And you've probably heard people talk about focusing on the bottom line. The business is looking at what is the impact on the bottom line, or how will this change the bottom line. And what that's referring to is the bottom line of the income statement. So when somebody's talking about the impact on the bottom line, what they're referring to is the bottom line of the income statement, which is net income. Or if we take net income and we divide it by the number of shares of stock, we get earnings per share. So earnings per share is just net income per share. Net income per share. So if I own 1 share of stock, this is my slice of net income that belongs to me. That's what we're looking at here. Now there's only 2 things that we can do with net income, or earnings per share. What are they? What are the 2 things we can do with net income?
Distribute it to the shareholders.
So we can distribute it to the shareholders, we can pay them dividends, or reinvest it back into the firm as an addition to accumulated retained earnings. Right? Those are the only 2 things with net income. Either pay it out to the owners or reinvest it for the owners, but it's the owner's money. It's the owner's money. Now, you have some other information down here about the income statement. We're going to come back to that after we talk about the income statement. So here's our example of our income statement for Yost Rocks. Again, you'll notice at the top that it says for the year ended December 31st. It's not on that day, but it's for the whole year that ends on that day. And so we have earnings at the top, or revenue. Not earnings, but revenue or sales. So it says total operating revenues. Sometimes it'll say sales. That's the top number. That's what we're starting with. Then we're going to subtract out our costs. And so cost of goods sold is the cost of acquiring or producing whatever it is we're selling. Right? So if we're a retail firm, it's the cost of buying those goods wholesale. If we're a manufacturing firm, it's the cost of producing whatever it is that we're selling. That's what cost of goods sold is. So it's a variable cost, depending on how many things we're acquiring and selling. Selling, general, and administrative expenses, that's more of a fixed cost. So that's kind of our overhead. That's going to include things like management salaries and advertising expense, the cost of operating the headquarters, those sorts of things. And so you'll see that abbreviated sometimes as SG&A expenses. And so we have revenues or sales minus cost, and I usually just lump those together when I'm talking about it to say costs. That's cost of goods sold and selling, general, and administrative expenses. Then we subtract out depreciation. And here we have $90 million in depreciation that we're subtracting out. What is depreciation?
The difference in what you paid for something and what you can sell it for. Or, well,
No, it's not really the difference between what we paid for it and what we can sell it for. When we think about, say, you drive the car off the lot and it loses value because it depreciates. So what does that mean? It depreciates or
Loses
depreciates?
value.
Loses value, because of the wear and tear, right? You've used it, you've done something to it, and it's going to have lower value. So that's what we're talking about with depreciation. Here's the important question. Do we actually spend money on depreciation? Does the firm write a check for depreciation? Did we spend $90 million on depreciation this year? No. It is a non-cash expense. And so let's pause for a second to some of the things I said at the beginning of class. I said I want you to keep in mind these things. Backward-looking versus forward-looking. The difference between accounting numbers and actual cash flows. And this is one of those big points. Because here we're subtracting out $90 million as if we spent the money, but we didn't spend the money. We still have that $90 million. This is a non-cash expense. And so what that means is everything below there is an accounting measure of profit, not an actual cash flow. It doesn't really tell us how much money we brought in. It's a measure of accounting profit. And so depreciation, we subtract out as if we spent the money. Why? Because we can. I'll give you the accountant's answer. Subtract out depreciation because we want to reflect the actual earnings and the costs of generating those earnings in an operating period, blah, 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 blah. So let me give you the finance answer. We subtract out depreciation because we can. We're not actually spending the money, but it reduces our taxable income. It's a tax deduction. It provides us a tax savings. It's called the depreciation tax shield. It shields us from taxes. So we subtract out depreciation. It provides us this depreciation tax shield, a tax savings from depreciation. And so that's what we like about it in finance. But we do want to be careful. It is not an actual cash flow. So we have our sales or revenues, we subtract out our costs, we subtract out depreciation, and that's going to give us this earnings before interest and taxes. Now I've jumped a couple of lines here. We have that, operating income, and then we have some other income. We're not going to worry about those details. Sales minus cost minus depreciation gives us earnings before interest and taxes, EBIT, earnings before interest and taxes. You'll hear it called EBIT. We're trying to get to net income. That's earnings before interest and taxes. That means we have two things to do before we get to net income. We have to take care of interest and we have to take care of taxes. So that's what EBIT is. So next we're going to subtract out interest expense, because interest expense is also tax deductible. This shields us from taxes. It's called the interest tax shield, because it also reduces our taxable income. Interest is tax deductible. And so that gives us our pre-tax income. Sometimes it's called earnings before taxes, EBT. In this case, $170. And then we subtract out taxes of $84, and that gives us net income of $86. So revenues minus expenses equals income. Sales minus costs minus depreciation gives me earnings before interest and taxes. I subtract out interest first because it's tax deductible. Then I subtract out taxes, and that gives me net income. Got a double line here. That's the bottom line, net income. This is just extra information. This is telling me what I'm doing with that net income. I can only do two things. I can pay it out or I can reinvest it. This firm is going to do half and half. It's going to pay out half of it and reinvest half of it. So that's what we have going on here. Earnings per share would just be taking that net income and dividing it by the number of shares of stock. All right, so we're subtracting out interest expense because it's tax deductible. What about dividends? Are dividends tax deductible? They are not. So we talked about that when we talked about the pros and cons of a corporation. Remember, sole proprietorship and partnership, the benefit was the income's taxed as personal income. For corporations, the drawback was this double taxation, because we're going to pay taxes as a corporation here. Take out the taxes, we get this net income, and then after we've paid taxes, we can decide to pay out dividends, right? This firm's going to pay these out in dividends, and when it pays out that dividend, when you receive it, you have to pay personal income taxes on the dividends you receive. So we have that double taxation. So again, we have this distinction between interest, which is tax deductible, and dividends, which are not. Any questions about the income statement so far? All right, let's look at the Home Depot income statement. So again, if you flip in your Form 10K there, it'll say page 32 at the bottom. It'll say the Home Depot Consolidated Statements of Earnings, which is what we have on the screen there. Again, here we're not worried about the specific details of Home Depot. What we're looking at are the similarities that, in fact, the rule book is the same for preparing income statements. Whether we're looking at a textbook example or a Home Depot or Starbucks or Disney or Coca-Cola or whatever it is, the basic format will be the same. Yes, you'll see some slight differences and things that are included or excluded, but the basic picture is the same. The information we're getting is the same. You'll notice in the upper right-hand corner that it says for fiscal year 2017. So that's from January 30th, 2017 to January 20, 9th, I think, 2018, whatever that fiscal year is. But it's over that window of time. Again, we have sales up at the top, $101 billion in sales. Then we subtract out our cost of goods sold, and then we're going to subtract out selling, general, and administrative expenses of $17.8 billion, and then depreciation of $1.8 billion. Depreciation and amortization. Amortization is like depreciation. So this firm is subtracting out $1.8 billion in depreciation, as if we spent this $1.8 billion, but in fact we didn't. So again, we're distinguishing between accounting numbers, accounting measures of profit, and actual cash flow. That gives us operating income, which is EBIT, and then we're going to subtract out interest. Here we have some interest income and interest expense. That gives us earnings before taxes, which is right here, and then we subtract out taxes, and that gives us net income. We have the double line here, so that tells us that's the bottom line. That's the end of the income statement. So Home Depot had $8.63 billion in net income. Keep in mind, though, that's an accounting measure of profit. That's not cash flows that it generated. That's not cash that it received necessarily. That's an accounting measure of profit. Down here, we just have some other ways of calculating earnings per share. So that net income per share, that's what we have down here. Any questions about that before we dive a little bit deeper? All right, so again, you see accompanying notes to consolidated financial statements at the bottom. If we want to know more information about some of these numbers, we would look into the notes. For example, provision for income taxes. Notice it doesn't say income taxes paid. It says provision for income taxes. This is, according to this accounting statement, how much we theoretically have to pay in taxes. And the way taxes work is we're going to pay some of those now, and we're going to assume we'll pay some of those later, but maybe not. $68 million. If we want to look closer at that, again, we can go to the notes to the financial statements. And so we saw note number 1 was a significant accounting policies. Note number 4 dealt with debt. We're going to flip a little bit further to note number 5 deals with income taxes. It'll say page 47 at the bottom, in the middle. And so you can see up at the top the amount of taxes that are from the U.S. versus foreign taxes. And then you can see underneath that at the bottom, current versus deferred. Current is the amount that we have to pay. Deferred is the amount that assume that we're going to pay later. We may or may not actually have to pay it later. But deferred meaning you don't have to pay it right now. You'll see on the balance sheet, it actually under liabilities, it has deferred taxes, taxes that we're going to owe at some future point in time, but we don't have to pay now. And so you can see all of that then leads us to this 5,068 number at the very bottom, provision for income taxes. And in fact, the whole next page also deals with taxes. And the page after that deals with taxes. So it's not just in the page after that deals with taxes. It's not just this single number here. There's 3 or 4 pages that talk about the details of taxes. And so we want to keep that in mind when we talk about the financial statements. All right. I've lost you, haven't I? To know me is to know that I see that I have a minute and 15 seconds and I'm about to plow into the next bullet point. But I know I've lost you. So we'll pick up here on Thursday. Make sure you take time before class on Thursday to review what we talked about today. Be ready for the quiz, and then you'll be ready to jump into this next portion.